You're about to hear a lot more about something called a Trump account. It's for kids, and if you're a parent or grandparent, it could be a big deal for your family's future. So today we're talking about what these Trump accounts are, how they work, and whether it makes sense or maybe not to open one for your kids or even grandkids. I'll keep it jargon-free, at least for the most part, and with some clear action steps you can actually use and take. In financial services, we often hear the same question from grandparents and even parents. Hey, I want to help the kids. I want to help my grandkids financially, but I just don't want to hand over money to them and have them blow it on some video game or a weekend out doing whatever they do. Well, starting in 2026, there's a brand new account designed specifically for kids that might help with that. It's called a Trump account. Okay, officially a 530A account. And it's like giving a child a head start on their retirement and long-term investing. Not just a savings bond that your grandpa or grandma stuck in a drawer somewhere and forgot about. All right, we're going to break down what this thing is, how it works, and how it might fit into your family's planning. What is a Trump account? Well, it's an account like a new type of IRA created under the One Big Beautiful Bill Act. It's designed just for kids, and the idea is to give them a tax advantage investment account that can grow over many years before they ever touch it. Think of it like, what's that phrase? The best time to plant a tree is 20 years ago, and the second best time is now. Well, why wouldn't the second best time be 19 years and 364 days ago? Think about that one. Well, here are the basics. It's technically called a 530A account, but everyone's calling it a Trump account. Not a 529. Remember those? Those are the state-sponsored college savings accounts. And not 530. Those are the old Coverdell education savings account. But 530A. It's tax advantaged like an IRA. That means the money inside of it grows tax deferred. You're not paying taxes along the way. And this one's meant to help children enter adulthood with some money already invested and growing for the long term. Yeah, I wish I had that. Who's eligible and how do you open one? Well, to open a Trump account for a child, there are a few simple rules, of course. The child must be a U.S. citizen, have a Social Security number, be under 18 on December 31st of the year the account is opened. Each child can have only one Trump account. Parents or legal guardians are the ones who open the account. And you'll do that by filing an IRS form. Yeah, Form 4547. Where did that 4547 come from? Think about that one. Or using an online portal that's expected to be available by summer of 2026. In fact, you may be able to file that form with your 2025 tax return, so the account's ready to go when the program opens in July of 26. So if you're the family planner, the financial planner in the family, the person handling the finances, that's your first mental note. Form 4547 filed with our 2025 taxes. All right, so when do these start and how much can you contribute? Well, timing is everything, not only in this, but in most of life, right? So the Trump accounts will be available in 2026, but you can't put any money in until July 4th of 2026. Who can put money in? Well, individuals, that's you, grandparents, parents, employers, even the government and charitable entities. The general contribution limit is up to $5,000 per child per year from individuals and employers, and that's in tandem, combined. Here's the twist. Compared with traditional IRAs, the child does not need earned income for money to go into a Trump account. Yeah, remember Roth IRAs, kids who are working? Well, then they can contribute to a Roth, but if you're not working, not making money, you can't put money in an IRA. There are no income limits for who can contribute. And on top of that, you may see extra money coming in from the government or charities. There's a federal pilot program promising $1,000 per account for kids born between January 1st of 2025 and December 31st of 2028. So do your planning there. Those government or charitable contributions do not count toward the $5,000 limit. So that could be in addition to the $5,000 limit. And here's a nice coordination rule. Contributions to a Trump account before age 18 do not reduce what that teen can contribute to a traditional IRA or a Roth IRA if, and we talked about this, if they have earned income. So if they're working a summer gig, mowing yards, making some money, they can contribute to a Roth IRA. It doesn't have any impact on what can go into their Trump account, and vice versa. So for a working teenager, you could have a Trump account growing on one track and a Roth IRA growing on another. Yeah, start them young. So how is the money invested? Well, it's not a do whatever you want brokerage account. The investments are limited on purpose. So the money in a Trump account can only go into eligible investments, which are generally going to be low-cost stock index mutual funds or low-cost stock index ETFs, exchange-traded funds. And those funds must be made up mostly of U.S.-based companies. That's based on criteria set by the Treasury Department. So you can't be out there day trading these things. Not for that. The intent is broad, long-term stock market exposure in the best companies in America, all at a low cost. And like a traditional IRA, the money grows tax-deferred. You don't pay tax along the way on the growth each year. And when can the kid, the child, your grandchild take the money out? Well, here's where these accounts really show their purpose. There's a growth period where withdrawals generally are not allowed. That period runs up until the child turns 18. Starting in the year they do turn 18, though, the account is mostly treated like a traditional IRA from a contribution and withdrawal standpoint. But here's a key for planning. If that Trump account stays separate from their other IRAs and is not combined with them when calculating taxes and penalties on withdrawals, well, that's a bonus. That is good. So that can give you some flexibility when deciding which account to tap first in early adulthood and which accounts to convert to Roth over time. So for you, if you're the family planner, this becomes another lever you can pull in their future tax strategy. All right, how about the tax? Come on, man. Uncle Sam always wants a cut of everything, right? Yeah, but not all dollars going into the account are treated the same. There are two main buckets: the individual contributions from you, your family, the grandparents. These are made with after-tax dollars, meaning you've already paid tax on that money. So you won't get taxed again on that. When the money comes out later, only the earnings on those contributions are taxable and potentially subject to penalties, depending on the rules. Government, employer, and any charitable contributions in the account, well, those are treated as pre-tax. And if they went in pre-tax, well, when you take them out, both the contributions and the earnings are taxable and possibly subject to penalties. In all cases, the investments grow tax-deferred as long as the money stays in the account. Well, how does it compare with, say, those 529s or UTMAs and other options? Yeah, well, you might already have a 529 or a UTMA. Does it even make sense to open one of these? Do you really need one more account? Well, Trump accounts are meant to be an addition, an and, not an either or kind of a thing. So here's the quick contrast. 529 plans, remember those? Great for education, very specific tax treatment, and penalties if not used for qualifying college and other educational expenses. Roth IRAs for kids, available if they have earned income, as we mentioned, flexible and powerful for long-term tax-free growth. And the UGMA and UTMA accounts, they're more flexible, but less tax-advantaged, and they become the child's asset outright when they become an adult. So a loss of control if that's your thing with those. Trump accounts are focused on long-term tax-deferred investing for kids, with strong guardrails and potential government contributions. So you're not really replacing your 529 or your estate plan with a Trump account. You're adding another tool to the toolbox. Well, that can matter for you, the parents and the grandparents, or if you are thinking about helping out your kids or grandkids. If you're in your 50s, 60s, or 70s, you might not be excited about one more acronym, but hey, this one is worth getting a handle on. The Trump accounts, yeah. They can help you move money to the next generation in a tax-aware, structured way. They can help you start kids investing early with built-in guardrails and broad index funds. And they potentially capture that federal $1,000 pilot contribution for eligible grandkids. So, hey, why not take advantage if you qualify for that? From a planning standpoint, it becomes one more piece to coordinate with your own IRAs and your Roth IRAs, your 529 plans, your gifting and estate strategy. All right, how about a couple things you can do if you're thinking about this? Sounds interesting, right? Well, make a list of all eligible kids or grandkids and write down which children or grandchildren are U.S. citizens with Social Security numbers. That's a key. And who will be under 18 in 2026 and beyond. That's your first target list for potential Trump accounts. And keep an eye on the calendar. Remember, it's July 4th, 2026 when you can first put money into the Trump accounts. And you can, as we mentioned, set them up even before then, though. So mark that date, and if you're working with a tax pro, ask about Form 4547 when you file your 2025 return so you're all ready to go. And then think about how Trump accounts fit into your broader overall financial planning and estate plan. Do you want this to complement a 529 or a Roth IRA for the kid or grandkid, or both? Is your goal education, their first home, or their long-term retirement? So if your main goal is long-term security and building investing habits, well, a Trump account could be a very natural fit alongside what you're already doing. Trump accounts for kids, yeah, new in 2026, and anytime something new comes along in the tax code, a little overwhelming. That's the feeling we all get. But at the end of the day, it's just one more way to plant financial seeds for the next generation. It uses low-cost investments, remember those ETFs, tax-deferred growth, and possibly some federal help, some federal contributions from the government. Never hurts, right? Hey, if you'd like more deep dives like this, especially on how these new rules fit into retirement and legacy, let me know your thoughts and ideas in the comments below. In the meantime, I'll see you in the next episode.